How has the presence of hedge funds and commodity pools in a CTA's managed account program affected performance reporting?
A CTA, when they present their trading performance, they're presenting the trading performance of their trading program. When a fund is one of those managed accounts in their trading program, there's a difference between the performance of that fund and what the CTA is earning for that fund. Funds have various expenses and sometimes income sources that have absolutely nothing to do with that CTA's trading program. And so the CTA, one, has to be aware of what those different sources are, and two, figure out a way to only account for the sources of income and expense that belong to their trading program and not to activities of the fund manager.
What kind of regulatory guidance has the industry gotten on this issue?
The regulations state that in a composite performance record, all of the accounts in the program must be trading the same program. And with funds, you have particularly sources of expense that have nothing to do with those other accounts. You have audit fees, you have legal fees, bank fees. So when the CTA is doing their monthly performance, they have to separate those two.
So there's a difference between the returns on trading programs and total fund return?
The fund manager, when they look at the returns, needs to understand that those returns are going to be different. And the trader has to be able to explain that to the fund manager that, this is normal industry standard. All I'm presenting is the performance of my program. And then those sources of income and expense that are solely being controlled by the fund manager are treated either as additions or withdrawals, depending on whether it's a decrease in the account size or an increase to the account size.
What about returns to cash holdings? How is cash treated in such funds?
It depends. If it's cash in the broker account that is earning interest within the broker account, that interest can be recognized by the commodity trading advisor because most of their accounts are going to be earning interest in the same way. However, if it's cash that is not in the brokerage account and that the fund manager is controlling the activity of that cash and the how he's managing that cash, that has nothing to do with the trader's program, and you're not going to have a comparable return on cash in the other individual accounts under the trader's program. The account size is going to change with this different activities, with the cash going out for expenses, with cash coming in for interest. And so the trader has to utilize the additions and withdrawals to equity to maintain the integrity of that account size, because that account size is what drives rate of return.
How can CTAs increase investor confidence while simplifying the performance reporting process?
If you have a knowledgeable in-house group that can prepare your performance records, that's great. If you don't have anyone in-house, or if you're a small CTA and don't have the manpower, you can give it to a third-party accounting firm to prepare your performance records for you. That can accomplish a number of things. One, it can give you comfort that you have someone who is familiar with the rules and the regs and that they're preparing your performance records in the correct way. It can also give comfort to your investors and potential investors that those returns are being calculated by someone who has a degree of separation from the commodity trading advisor. You can even add another level to that separation by having the FCMs directly send the brokerage statements every month to that accounting firm. So it brings the CTA out of the picture, and it has the appearance of a third party calculating your returns, and that will give your investors and potential investors a lot more comfort. The other alternative is to have a public accounting firm come behind whoever has prepared those performance records and do what we call a performance record examination. Now, the result of a performance record examination is you get a report that gives you assurance that the returns are being calculated in the way that the CTA is saying they're being calculated. The assurance that you get is equivalent to the assurance one would get from an audit of a financial statement. The other thing is that trading programs are becoming more diverse and more complicated because the type of products they're trading is becoming more diverse. And if you have an outside group taking care of that part of your business, then it leaves you more time to take care of the marketing and perfecting your trading.